This is a special edition of my monthly newsletter. The topic this month is, I think, very important, and it's just not quite conducive to writing down on one page, so I thought I'd do a quick video. I'll try to keep it short. To set this up, I have to talk about the price to earnings ratio. Sorry about that, but bear with me, we'll get through this in a couple of minutes. In order for us to want to own a company stock, the company has to earn something. So most people don't want stock in a nonprofit. So the price to earnings ratio, or PE ratio, represents how much we're willing to pay for a year's earnings. It's basically a measure of how expensive stocks are. So if a company earns $1 a share and the stock sells for $25, then it has a PE ratio of 25. So we're paying $25 for every $1 in earnings. And for most companies, the PE ratio tends to stay about the same. If a company suddenly comes out with higher earnings, temporarily the PE ratio will drop, but then the price will go up because the company has better earnings and the PE ratio goes back usually close to normal. Same thing can happen on the other side. If earnings suddenly drops, PE ratio gets higher because the denominator got smaller. And then if the company's not earning as much, the price tends to follow and the PE ratio goes back to about normal. So it has a very strong tendency to return back to the average or return to the mean. And every company will have a different PE ratio that it tends to stabilize at. So if we take a look at a couple examples, Intel right now, PE ratio is 14.8, so we're paying $14.8 for every $1 in earnings. For some reason, people are willing to pay a little more for General Electric earnings. It's still the same dollar one way or the other, but they're willing to pay more. For Facebook, they're up at $39.40 for every dollar of Facebook earnings. So there must be an expectation that Facebook is going to continue to grow. And then Amazon, if you're paying $204 for every $1 of Amazon earnings, you think Amazon's taken over the world. What I really want to talk about is the PE ratio of the S&P 500. So this is the average PE ratio of all the stocks put together in the S&P 500. And you can see going back all the way to 1920 something, it bounces around quite a bit. The average during this entire time was 15.66. So that's the long-term average PE of the S&P 500. You can see lately we've kind of stayed above that level. And back in the 50s and late 70s, we got pretty far below that. So whenever we get below that line, it means that stocks are inexpensive. They're cheap. So back here, stocks were very cheap. This was late 70s, right after a period of really high inflation. Great time to buy stocks because that kicked off the 80s and 90s. And during that time, stocks got very expensive. And it was right here in 1996 when Alan Greenspan came out and talked about investors were showing irrational exuberance. Looking backwards from that point, you can see that was almost the all-time high in terms of the PE ratio. And so Alan Greenspan at the time was saying, all right, this is getting ridiculous. Now, it kept going up even higher than that, but that's where irrational exuberance came in. Should probably talk about this little peak. This wasn't because suddenly everybody wanted more stocks and it drove the prices up. What happened here was that earnings, because of a recession, suddenly fell through the floor and prices didn't catch up for a little bit. You can see it didn't take long for the prices to catch up on the downside, but what drove that higher was that earnings dropped, not that prices went higher. So where are we at today? This chart doesn't quite go to today's value, but where we're at today is 25.79. So you can see that's just a little bit higher or more expensive than when the term irrational exuberance was starting to be talked about. Okay, here comes the important stuff. Whether you make money in stocks depends a lot on how expensive stocks were when you started. So what I'm going to do is take a look historically at the one-year returns based on what the starting price to earnings ratio was of the S&P 500. So let's say we had a year where the price to earnings ratio was 10 and The following year, the market returned about 18%, so we plot that. And here we have another period of time where the starting PE was 20, and the next year's return was a little bit negative, so we plot that. And so we're just going to go back and plot all these historical returns based on how expensive stocks were when we started. Now, this is tedious as all get out, so I have to thank Brian Wells for finding a couple of graphs where they did that for us. And this is what it looks like. This is a bunch of historical one-year returns of the S&P 500 mapped against the starting PE ratio. Now, not all of these data points start on January 1st. They kind of start whenever the PE ratio is adjusted. But this data goes all the way back to 1964. Now, if you close one eye and maybe you had too much to drink and you were sitting with a guy named Rorschach, you might be able to see a pattern here. I don't see much of a pattern. Now, we're up here at this X, so really we're only concerned with the data points that are up here in this expensive region. But even then, I don't see any discernible pattern. This looks pretty random to me. Interesting that a lot of people base some very important investment decisions on 1 year's worth of data, but again, it looks pretty random. However, if it stopped here, I wouldn't have much to talk about. So, as you might guess, there's something more to this. 1 year returns might have some entertainment value, but they really don't have much of an impact on people's ability to retire or even stay retired. But 10-year returns are a different story, and we see a very distinct pattern when we look at 10-year returns and the starting PE ratio. Again, we're really only concerned with stocks that are up here in this higher region where stocks are more expensive, and today, again, we're right here, a little bit more expensive than all these data points. And I think we've got a problem. So for those who are just invested in mutual funds, or maybe the most popular thing is to be invested in an S&P 500 index fund, if you still think you're going to get the long-term average return of stocks, or even just a decent return, what you're banking on is that the data point starting today and looking out 10 years is going to be this outlier that's way up here. Again, it could happen. There's nothing in the market that's certain, but in terms of what's highly likely, I would say it's highly likely we're going to stay pretty close to this trend line, which means we would have to break the trend line just to have a positive 10-year return. So my thinking is, unless stocks have become permanently more expensive for some reason, or maybe you're an expert in market timing and so you only pick stocks that go up and you avoid all the ones that go down. I'm not one of those. Then we have to think of different ways to invest. This also explains why investors like the Yale Endowment only has 4% in U.S. stocks right now. And almost all the major endowments are twice as heavy in foreign stocks as they are in U.S. stocks. So this is the chart that I thought was so profound. I wanted people to see it. I hope you find some value in it as well. And with that, we will end. Thank you very much.